what we're talking about, comparing that Kaizen to, is a leveraged IUL. A leveraged IUL is simply a strategy created through the policy's own built-in index loan feature. So access timeline in a leveraged IUL, 2 to 3 years. With the Kaizen, you cannot access the cash value for the first 15 years. But what we're talking about, comparing that Kaizen to, is a leveraged IUL. And what I mean by leveraged IUL is it's an index universal life insurance policy that has a match, that has a dollar amount added to it. There's your contributions. Being added to those contributions is additional dollar amount that is actually coming to you from the life insurance company, and it's based on what you've contributed. So that match ends up functioning in this space and helping you generate and build wealth. But similar to what I did with Kaizen, what do I mean? Let's be a little bit more specific. A leveraged IUL is simply a strategy. So again, we're just comparing strategy to strategy. And it's a wealth building strategy that uses leverage, and that leverage is created and built inside the policy. I'm not going external from the policy to get this leverage. In a Kaizen, I'm going to a bank. In a Kaizen, I have to get approval from a bank to add the leverage to my policy. Whereas with a leveraged IUL, I am creating that leverage inside the policy, and I am borrowing from the life insurance company, but it's all internal to the policy. I am not leaving or going external to grab any of that leverage. So it's created through the policy's own built-in index loan feature. It absolutely has a 0% floor for protection, and the whole goal and purpose is to build compound. It's so that your money can make money, providing you tax-free growth, accessible to liquidity, and ultimately secure leverage is the goal. Moral of the story, leveraged IUL compared to a Kaizen, they're both strategies. They're both strategies using an index universal life insurance policy. But as we have talked about several weeks now, it boils down to how you structure that index universal life insurance. Some of the basic differences between these two strategies, I'll call it, some of the basic differences is, what is that access timeline? Meaning with the Kaizen, you cannot access your funds until the leverage dollars you're using are paid off. And the leverage dollars you're using, for the most part, I'm sure there may be variable time frames as to how long you use these dollars. But in this case, no access for the first 15 years. Meaning, when you contribute to this policy, you cannot access the cash value for the first 15 years. So now, in this line alone, accessible timeline. What's the goal? If the goal is, let's call it infinite banking. If the goal is to be able to leverage the cash value in my policy to be able to do external investments like buy real estate, if that is the goal, if I can't access my funds for the first 15 years, it's going to make it pretty difficult for me to do infinite banking within that first 15-year period. So access timeline in a leveraged IUL, 2 to 3 years. A lot of times it's, if you have cash value, you can access it. So if we're doing infinite banking and the goal is to leverage your cash value to go do something external, if you have cash value, so even at 30 days, 45 days into your policy, if you have cash value and it's accessible, you can absolutely use it. But if we're trying to take full advantage of the leverage portion of this leveraged IUL, I would say allowing your policy to function and grow, to mature for those first 2 to 3 years is critical. The loan type. What is the type of loan inside of a strategy like? Again, for Kaizen, we are actually going to a bank, borrowing money from a bank. So that means there are some requirements of you in order for you to be able to qualify for that leverage coming from a bank. The leveraged IUL, we're using the participating loan inside the policy, and that feature takes effect sometimes in year 2, but in most cases starting at year 3. So it's the participating loan inside the policy that you're leveraging. Credit requirement. This is important, and this varies actually. I'd say on average, you and your spouse need to have in total somewhere around $2 million in net worth. This specific policy we're going through, I kind of peeled back all of the layers and kind of jumped through a few rabbit holes myself to just confirm. And what I learned is this specific policy that we're going over today, the net worth requirement was $1 million. But the bottom line is there's a net worth requirement. You might ask why? Why would there be a net worth requirement for a strategy like that? It's because if the bank if the life insurance company is going to a bank to gain leverage for you on your behalf, there needs to be some criteria there for the bank to say, yes, I will provide this leverage to you, life insurance company, for this policy, and there needs to be some credit worthiness there for you to be able to receive this dollar. There's a minimum on worth or your net worth. Whereas with a leveraged IUL, because you're using leverage based off the contributions that you've placed inside of this product, there's none required. Flexibility, the ability to use my funds. This goes back to what's the goal? If the goal is to be able to use the cash value, then we need for our policy to be flexible. And again, I am calling having to wait 15 years not being flexible. We can argue that and just so we're clear, this isn't something that I made up. Again, this is maybe hard to read at the moment, but this is right out of the Kaizen documentation. This is not coming from me. And I'll zoom in on this area that I highlighted.
Yeah, because nobody could read that.
I know. This area, I highlighted it for a reason. And it's because let's say it's you. Let's say you receive this document. And what page is this? This is page 7 of 8 pages. Let's say you receive this document. And notice over here, there are initial points, meaning you are requested to review this document and acknowledge that you've read what's in it. But let's be honest, who's going this far? And as much information, I am not a fan. I don't read posts. My wife will send me a text.
Sure do.
And if the text has this amount of sentences in it, I am going to go back to her and say, what did you say? Because I have no idea because I'm not reading it. So my point is, who in there, I'll call it logically, who do you know make it this far to be able to fully understand what this document states? So I zoomed in. What is this actually saying? And I'll read it.
Why don't you zoom in on my text? Jeez.
I'll read it from here. And what it's saying is, client will not have what? Client will not have access to the policy. Do it again. Client will not have access to the policy, the cash values, the death benefits, or the living benefits until the loan is repaid. The client will not have access to the cash value until the loan is repaid. Now, something that's irritating to me, and it may not be irritating to anybody else, but it is absolutely irritating to me, is this piece, or living benefit. Okay, so what are living benefits? Well, one of the luxuries of having a policy like this, and I don't care, it's any cash value life insurance, is some of the, I'll call it the riders that are built into it. The living benefits rider says this: if for whatever reason I physically cannot do 2 of the 7 things I'm supposed to do as an active human being, like bathe myself, feed myself, walk, talk, if I can't do 2 of those 7 critical things, then I can actually access my death benefit, which means it becomes a living benefit. I can access it now while I'm living to be able to pay medical bills or whatever the case may be. But this says, and again, I'll do it again, this client will not have, not my words, all I did was copy and paste, will not have access to the policy, the cash values, the death benefits, or the living benefits until the loan is repaid and the assignment is released. So what does that mean? That means this loan has to be fully repaid before you can access your cash value. Let's back up and go back to the goal. What was the goal? When this client shared this with me, the purpose of this policy was to, number 1, build wealth. But they were looking for access to cash value to be able to participate in external opportunities like investing in real estate, buying rental properties, buying crypto. They wanted access to leverage. We talk a lot about leverage on this channel. The purpose, the goal of this policy is leverage. The next purpose for this policy is they want to build a family bank. And we'll dig a little bit more into that later. But building a family bank, meaning they want to be able to lend money to the people in their family to be able to accomplish goals like buy homes, pay student loans, pay for college, buy the first house, whatever the case may be. But the goal is to build a vehicle that we can leverage and use to be a family bank. But again, you can't access these living benefits, the death benefit, the cash values until the loan is repaid. To me, that's a significant problem in a strategy like this. But I go back to, when you ask me to review your policy, my first question is, what's the goal? Because your policy should at least be meeting the goal that you. High level, what are some of the basic differences between these two? Access timeline, loan type, credit requirements, flexibility, control. Again, if I've got to wait 15 years before I can access my cash value, I have very little control over those first 15 years. Whereas with the leveraged IUL, if you have cash value, you can access. And then funding method, finance. For a Kaizen policy, leveraged IUL, you are actually funding it based off your contributions. As you contribute to your policy, you build cash value. As you contribute in year 1 and year 2, the cash value from year 1 and year 2 is what the life insurance company uses as collateral to allow you to bring those dollars back into your policy as leverage. The leverage is fully created by you contributing to this policy. And the ideal use case, why would I want a Kaizen? What's the ideal use case? To me, the ideal use case is set it and forget it. The ideal use case is I'm looking to put a certain dollar amount into this policy. I don't care what happens for the first 15 years. I am putting this money away so that I can use it at some point in the future. So again, long-term goal. But let's be clear. A leveraged IUL also fits that same structure. It's absolutely focused on legacy and income at a certain point, but in addition to that, how about immediate access? So on the surface, those are the basics. How about loan structure? So when we leverage and or borrow dollar amounts from this policy and put it back into the policy, what does that structure look like? Well, for Kaizen, again, it's third party. We're going to a bank. We do have to qualify, so there has to be there's an income requirement. There's a requirement on your net worth. There's a minimum amount that you're contributing into this policy. But the bottom line is it's third party financing is what we're using. It requires strict qualification criteria, as I mentioned. The interest rate on the amount that we borrow is variable, and I'll show it to you. When we dig into the illustrations, I'll walk through that interest rate and how it changes, but it's a variable interest rate exposure, which means depending on where interest rates are, determines spread that you have inside your policy when you use it. And so the illustration you have is based off interest rates as of today. Based off where the government decides to turn could impact what those interest rates look like tomorrow. So you have very little control, especially over that 15-year period, as to what that looks like. And then mandatory structured repayment schedule, meaning, as I mentioned earlier, you cannot access the cash value until the loan is paid back. As it relates to a leveraged IUL, it's a little bit different. Again, the loan is generated by you, so therefore you don't need any external support to be able to do it, or to be able to have it, and there's no credit check or qualification needed. The loan rate itself is also capped, and then it's optional as to whether or not you want to repay it.